welcome to this TIOmarkets webinar on interest rates. We just wanted to touch base on interest rates today with you and go through with you why they are important in your day-to-day trading activities, what interest rates really truly mean, and movement in interest rates, and how they affect you directly as traders and things that you should be looking out for. So first and foremost, with interest rates, especially when trading foreign exchange, interest rates are important because whenever you're trading FX, you're trading one currency against another, and the interest rates from those particular countries are probably going to be at different levels. It's going to be what we refer to as an interest rate differential, and that can have an effect on that particular currency pair. And it's also not just about where those interest rates are trading currently, but also what the future expectations on interest rates are. You'll notice when we have the central bank meetings, the Federal Reserve, the ECB, Bank of England, the RBA in Australia, the Bank of Canada in Canada, we always listen very carefully to what they have to say about future interest rates, because that's what really interests us most of all. We know where they are now, but we're interested in where they are going. And I'm sure many of you will have seen over the past couple of years with the Federal Reserve having raised interest rates fairly progressively off their historical lows from the financial crisis. The market has paid a lot more attention to what the Fed say is going to do next rather than what they actually do on the day of the meeting. So that's always very important. And interest rates essentially are a monetary policy tool used by central banks for the most part to control inflation in the economy. If there is too much inflation, interest rates tend to go up. When there is not enough inflation, then interest rates tend to go down. And as we saw during the financial crisis, 2008, 2009, interest rates were slashed by global central banks because they wanted more money getting into the system and to help with credit, etc., which had all but dried up at that time. And even here in 2019, we still see major central banks with extremely low historical rates. If you look at the ECB, they effectively have negative interest rates. Switzerland has negative interest rates. Denmark has negative interest rates. So there are still a lot of very low interest rates in the world, which obviously have an effect on their currencies, and also give a fairly good indication as to where the central bank sees that particular economy. You know, one thing we've seen in the past couple of years is the Federal Reserve have been raising interest rates. Why have they been raising interest rates? It's not totally an inflation thing. I mean, they've had inflation around the 2% mark, which is their target. It certainly wasn't running away, but they'd start to see some real growth in the economy. The labour market was performing extremely well. We've got unemployment at basically at historical lows. GDP was going well. We were seeing increases in manufacturing and industrial production, consumer spending, retail sales, etc. So all the things that were pointing to the economy starting to really grow and improve from the financial crisis, and the Federal Reserve wanted to very slowly raise interest rates to stop the market, stop the economy overheating. And by overheating, we're saying, you know, growth is good, but sometimes it can grow too quickly, and inflation can start taking hold. So the Federal Reserve wanted to be preemptive in terms of handling any overheating. At the same time, we've seen many of the other central banks around the world have done nothing with interest rates, and that is probably an indication of the relative strength of the different economies, which can also give you a fairly good indication of maybe where the respective currency pairs may go going forward. And we've certainly seen, not entirely, but we've seen a fairly decent amount of dollar appreciation over the past couple of years. So that's definitely one major reason why you want to look at interest rates, because they really can be a very good indication of the economy and how the different central banks see their own economies and the effect that can have on exchange rates, and obviously as a tool during a crisis like we saw back in 2008. So that's certainly worth seeing. So low interest rates, high interest rates. It would be wrong of me to say that the higher the interest rate, the stronger the currency. You have certainly amongst the G20 countries, it would probably be fair to say that if you have interest rates in one country going in one direction and interest rates in the other country going in a different direction or not moving at all, then that interest rate differential, that increase in interest rate differential, will probably be beneficial to the currency that has the higher rate. What we do also hear is we hear of exorbitant interest rates. We're not talking about 1%, 2%, 3%. We're talking about interest rates at 10% or 20% or 50% or even higher. Tends not to be the case in developed nations, but do keep in mind when you're talking about countries like Venezuela, you're talking about Argentina at the moment. Certain African countries, they can have very, very high rates of inflation, very, very high interest rates, and that certainly is not beneficial to their currency. The currency continues to weaken. So, but for most retail purposes, those are not currencies that you're ever going to have any trading exposure to, but something to keep in mind. It isn't always the case that just because the interest rate in one country is higher than the other, excessively so, that it means that currency will necessarily appreciate. The other thing which interest rates affect you as well is what you see on your account at the end of the day. So if you're holding positions beyond the end of the meta-traded day, which is at 23:59 and 59 seconds in meta time, which is the same as 5 p.m. New York time, 10 p.m. London time. If you have any positions which are held over that time, you will see that a swap rate is normally applied to your account. You may get a credit, you may get a debit. One of the major determinants of what that swap rate will be is interest rates. Because effectively when you hold a position, and I'm just going to take a very simple one here. Let's say you have a position in the New Zealand dollar against the Swiss franc. Okay, and I'm just picking that because there's a fairly sizable interest rate differential between the two. So let's say you're long New Zealand dollars and short Swiss francs. Now what that effectively means, and again, retail trading is not a deliverable product. So you don't actually have a position, holding New Zealand dollars at the bank in New Zealand and having an overdraft to the bank in Switzerland because you're short Swiss francs. But that's effectively what you have. And then what we do in the retail market is we try to recreate real true market conditions. So if you are long New Zealand dollars and short Swiss francs, at the end of the day, if you had New Zealand dollars sitting in a bank account in New Zealand, you would get a credit for interest accrued for that one day, and that would be applied to your account. Similarly, if you had an overdraft in Switzerland, you would probably get a charge for having an overdraft in Switzerland. Now, Swiss interest rates are actually negative, so you may not get a charge for having an overdraft. But the point being, New Zealand interest rates higher than Swiss interest rates. If you're long New Zealand and short Swiss, you effectively will be getting a net interest gain at the end of one day. So you will see a credit applied to your account. Now, these, what we call them very short-term interest rates, we call them Tomnex points, essentially what they're called. Those are actually traded in the market each and every day. All the big banks trade them. Anybody basically that has a position, corporates, hedge funds, money managers, etc., are all involved in these markets. The biggest determinant, as I said, is interest rates, but supply and demand also can push those those rates around as well. So just keep in mind it's not just a simple mathematic of looking at it and saying, okay, well, the interest rate of one currency is 1% higher than the other currency, therefore I should be getting X. It doesn't quite work as simply as that because it is a traded product. But it certainly will be something which will determine what swap rate is used. And something you hear in the FX markets quite a lot is a carry trade. Okay, and what is a carry trade? Carry trade is really where a trader is looking to gain by holding one particular currency. The gains they're trying to accrue are going to be based on those swaps at the end of each day, or at the end of, you can have it over a day, you can have a month, 3 months, however long you want for all intents and purposes. But that's what traders are looking to do. They're looking to accrue that interest. So they might be willing to, and I'm just using this as an example, and it's certainly not something I suggest anyone does. I'm just using as an example. Let's just say South African Rand. Okay, South African Rand has much higher interest rates than the US dollar. So a carry trader might be willing to take the risk of the South African Rand depreciating against the US dollar, but be willing to get the interest on their Rand holding each day, which they hope will be enough to offset any losses they might get in the dollar Rand exchange rate moving against them. And that's known as a carry trade, which is really all about accruing interest. Used to be very popular back in the day using yen crosses. Yen crosses were always very popular because Japanese interest rates were essentially zero, still are essentially zero for that point. And some of the higher bearing currencies, such as the Australian dollar, New Zealand dollar, and obviously beyond that, things like Canadian dollar, Mexican peso, etc., paying much higher rates of interest. These were very popular trades. So keep that in mind at the end of the day. The swap rates are certainly determined by different levels of interest rates. So that really just sums it up. The two main areas, where interest rates affect you. One, within the market, future interest rate expectations based on the different economies and how they're performing going forward. And then second, looking at end of day swap rates and how that will affect debits and credits to your account in your medical trader accounts. If you have any questions, please do not hesitate to reach out directly to our support teams, and we wish you all the very best of luck with your trading. Thank you.